opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 24 of the Macro Corner podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmueller. My co-host is Jannis Meindl. Welcome to the show, Jannis.
Hey, Paul. How are you doing today?
I'm doing great. How are you?
I'm doing great.
Good. Let's dive right into it here today. We had a big number that came out last Thursday, but what are we looking at with regards to the high yield bonds, with regards to corporate as well as high yield with different countries?
Yeah, so what we do see is that in Europe and the US, the corporate credit market has tripled in size since 2008. That's largely a result of the fact that central banks globally have kept interest rates near zero bound, and therefore there were a lot of companies that would not have otherwise been able to do so to borrow a lot of money and ultimately put that money into assets that these companies own. But it would be sort of naive to think that all these credit lines and all the money went to good use. It surely went to some companies that are zombie sort of operations, which just means that they don't have good use for that money, that their assets are not economically viable. And JP Morgan estimates has an estimate out there that 88% of the leveraged loan market is covenant-lite, and that number is up from 17% in October of 2008, so just before the 07-08 crisis that was. So it is even up from that level, and that just means that a lot of borrowers have been able to get a lot of money for not really that strict of conditions, which means there are probably a lot of chickens that got to come home to roost in the process of this deleveraging cycle amidst higher cost of capital, which we talked about last week.
Absolutely. And I a phrase that I learned when I was a youngin' was borrow money when you can, not when you have to.
Absolutely. And I mean, Moody's came out with an estimate saying that they expect the default rate among high yield borrowers to climb from this September, when it was 2.3% in September of this year. They expect that number to go up to 7.9% in September of next year. So that just goes to show that as these maturities come due, as the high yield borrowers have to either refinance at levels that they cannot afford, or just have to default on some of these loans as they're not able to refinance, that some of these high cost of capital dynamics are only going to come to fruition starting next year, as some of these high yield companies are not going to be able to sustain operations if indeed the Fed is going to keep rates at current levels.
I think an important thing to note is that many of these derivatives are, ways that you are able to participate in these debt markets now versus that 2007, 2008, is that many of these instruments are cleared. They are backed by clearinghouses, and it's a little bit, like you said, it's tripled in size, but I think that's also due to the fact that you do have a little bit more protection to participate in these markets.
Yeah, and I mean, overall also you have had this tremendous growth in alternative assets, namely private equity, that has come in with a lot of money. A lot of endowments, pension funds, and so on have looked for alternative ways of allocating their funds in assets that they think are a little bit less volatile. But ultimately, one needs to think about the fact that the volatility suppression per se comes at some cost.
Right.
And that cost may come due next year.
In the past, we talked about, the shift from goods inflation to services inflation. And with that said, why was Thursday's CPI number so important to the equity markets? I mean, that thing just ripped. And what do you think that number on Thursday specifically is going to do for those markets looking forward?
Yeah, so one of the ways in which I like to think about this number is exactly what Bill Baruch was saying on CNBC last Wednesday. He was basically laying out the landscape and coming into not this last Thursday CPI report, but previous CPI reports where the risks were basically skewed to the downside for risk assets because of the way that the inflation expectations, as measured, for instance, by the Cleveland Nowcast, set up. And what we saw this time around was that the year-on-year inflation nowcast number showed an expectation for 8.09 on a headline increase, and that number came in at 7.7%. That's a 0.44 increase on a month-to-month basis. And then core in particular, which is arguably the more sticky aspect of inflation, came in at 6.3 on a year-on-year basis. So this was ultimately below expectations, but as we have laid out in the past, is that a lot of market participants have been watching this shift in spending from the goods side to the services, and that would lead to a logical conclusion that more of the inflation is going to be on the side where most of the spending occurs. So what was really encouraging about this report was that the services less rent of shelter CPI has shown deflation. So prices of services X rent of shelter has gone down on a month-to-month basis. The same dynamic is fares. So even though airline demand and the demand for travel writ large is really through the roof, and especially now that Europe's been opening up, and also in the US, I mean, you've just had stunning demand, and you could see that in the various earnings reports some of these service-based companies have put out. But even as the demand has been above expectations, these prices have not really followed through to the same extent, and that is a really encouraging sign, given that a lot of people were afraid of the same inflation dynamic playing out in the services as we saw on the goods side amidst bottlenecks.
Right. Yeah, I mean, looking, it is the middle of November here in the United States, and with the holidays fastly approaching here in the US, a lot of eyes are turning to those retail sales numbers. I will have to say, I think that Black Friday turned into Black November at this point. All the ads that I see on my computer and on television, et cetera, they're kind of extending that. But industrial production is also still very, very strong. So where do you see that a Goldilocks scenario might be approaching going into 2023 with regards to inflation and retail sales? Just knowing that those numbers are lagging indicators, but where do you see that going?
Yeah, so one of the things that we, of course, are monitoring is spending dynamics. I mean, 70% of the US economy, I mean, 2/3 to be more precise, is made up by the consumer. So consumer spending is extremely critical. And one way in which we can measure consumer spending is the retail sales. And retail sales have been way above pre-2020 trend. And one is definitely has to wonder whether that a number will go back to trend or whether it can be sustained at such high levels. I mean, we were just talking about this offline. How many hoodies is any given person going to buy? How many pairs of shoes is any given person going to buy? So one needs to be cognizant of the fact that some of these economic numbers are mean reverting. And we have seen some evidence of that in earnings reports such as FedEx, UPS, Amazon just today announced a layoff of 10,000 employees, and that is ahead of holiday sales. So some of these numbers are definitely indicating a slowdown, but just the degree to which this slowdown might occur might be a little bit less than the recession camp is currently forecasting. And a similar thing is playing out on the industrial production side, where economic activity amongst industrial producers has remained extremely strong. I mean, some of the largest contributor to that is, of course, the oil, natural gas, and chemical producers who have really benefited global arbitrage and energy cost. And the U.S. is, of course, positioned with a tremendous advantage right now because we have a lot of natural resources. But yeah, I mean, economic activity has kept up some surprisingly strong levels here, and the extent to which this is going to continue will determine the combination of inflation and growth. And when you think back to pre-2020 and what really made risk assets go up in such a stark manner, it was a combination of low inflation and somewhat stable growth, even though that growth was not high at all. I mean, we're talking about 1 to 2% GDP when
Right.
all of that was going on. I mean, then you had some reacceleration in 2016 with deregulation and whatnot, but overall, it was really stable and low growth. So if market participants start having an outlook that would infer that we'll return to a growth and inflation scenario that's somewhat similar to that, then that would be extremely positive. But then we have to look at the flip side, and also what we mentioned in the initial part of the podcast, which is this deleveraging cycle.
Right, right. I mean, and it also going back to those previous years that you had just mentioned, there is there weren't really many places to put your capital. Like you said, with the low interest rate environment, but now I would assume that investors do have, many different choices, like we spoke about earlier. The high yield market, you have, a 10-year at 4%. You have tips out there that are doing really well. I think the average is around 7 now on those, but there's different choices for capital.
That's exactly it. I mean, that's what's been commonly referred to as the Tina effect. There's no alternative, which of course drove a lot of people into risky assets, and namely stocks. I mean, that also contributed to the enormous growth in the alternative investment space. But yeah, I mean, right now there are definitely alternatives. When we look at the difference in between 10-year bond yields and the earnings yield, which these S&P 500 companies generate, then you can make the case that stocks are not nearly as attractive as they once were when you consider that the rates were a lot lower back then. And that's also why we need to turn to the 3-month 10-year yield curve, which is the Fed's.
We love talking about yields, and I wanted to touch on that before we leave our listeners here. But yeah, what is going with the 2 or 3 month versus the 10-year? What's going on with that these days?
Yeah, so in the past we talked about the 2-stance curve, which is probably the most widely watched recession indicator, and the Fed's preferred recession indicator, though, is 10-year yield curve, which means if that one's inverted, then the Fed will pay attention. And on the back of Thursday's CPI report, we saw that the 3-month 10-year curve inverted to negative 25 basis points. As of right now, it's trading at negative 21 basis points. So that definitely points to some sort of slowdown in the future. And we need to be really cognizant of that. So while economic growth has held up, we do know that all of these economic indicators are lagging indicators while the yield curve is forward-looking. So we need to think about where the puck is going rather than where it's been. And this indicator is definitely pointing to some of that deleveraging dynamic we laid out in the beginning of this podcast, playing out to a much greater degree, some of these cost of capital implications following through into the real economy, some of these zombie companies getting pushed out of the market. And that's what the yield curve is telling us right now.
I love it. And time will tell what's going to happen in risk assets. But Jannis, thank you so much for joining me again today. Looking forward to seeing you next week. For all of our listeners out there, the Blue Line Futures chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to podcast@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and so much more. Jannis Meindl, thank you so much. We will see everybody next week.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.